Welcome to the Business of Hotels podcast, examining the issues mattering most to owners and investors. And now, your hosts, Gary and Glenn.
Hey everybody, and welcome back to the Business of Hotel podcast. I'm Glenn Haussman.
Gary Isenberg.
And I'm really excited to be here today. Although, Gary, I got to tell you, I have no idea what we're going to be talking about.
And that's great, Glenn, because I do.
I always like that you want to keep me on my toes. You don't want me to be too prepared. I think maybe you're just trying to nail me and prove that I don't really know anything.
You're right. And also, I want to be a little bit of the host instead of you always kind of talking to me and questioning me and kind of, I think really what I'm trying to say is over-talking me, talking over me,
all right.
And kind of taking control. I'm letting my ego flow a little here, and I want to take a little bit of control of the conversation.
And I totally respect that. And I got to start right off. I know we're just starting this series, but I have a really hard time sitting back and not being a host. I was just recently on a wellness panel. I wasn't moderating it. I was a panelist, and I sat there the entire time just gritting my teeth because I knew I couldn't keep talking.
Great. Well, hopefully we'll continue to keep that anxiety flowing today. So, Glenn, what we're going to talk today, we're going to talk about hotel management contracts and management companies.
Oh, that's a really clever idea.
Yeah. Well, I don't know how clever management contracts are, but...
Well, it is, because I got to tell you, Gary, the more that I know about hospitality, the less that I feel I actually understand. And there's a lot of these things that are bubbling below the surface of the hospitality industry that we don't talk about at industry events. And I think this is going to give us a real opportunity to get to these types of issues that aren't readily discussed but are so absolutely important to understand.
Absolutely agree with you, Glenn. So what do you know about management contracts, Glenn?
I know that they're probably long and complex.
Good answer. It's interesting. I think one of the most difficult decisions or most important decisions that a hotel ownership makes after choosing an asset to acquire or develop is who to affiliate with, both on the brand side and the management contract. But today I want to speak more specifically about management. And there's really two types, right, Glenn?
Right.
Do you know what those two types of management contracts are?
Good ones and bad ones?
Very good. Actually, you have what we call brand managed.
Right.
That's where you would have like Marriott who would brand the hotel and manage the hotel.
Or to even simplify it, like a Four Seasons, for example, because that whole brand, basically, they manage your property, right?
Correct. And then the other side of management would be a third-party manager, and in that arrangement typically would be a franchise hotel,
right,
or an independent,
mm-hmm.
And then a third-party management company. It's interesting you bring up, for example, you brought up Four Seasons.
Mm-hmm.
Four Seasons, you cannot franchise. You can really only brand manage. But there's other brands that you can do either or, like Marriott, Sheraton, Hilton, etc. So,
didn't Marriott actually just start off by owning and managing absolutely everything, and then at some point kind of change their formula?
Correct.
Mm-hmm.
They managed all their hotels initially on the Marriott full service brand, and then they allowed a few management companies like Interstate and so forth to manage properties for them. And there might have been one or two other management companies as well. But then the whole emergence of the select service brands such as Courtyard and Fairfield and Residence Inn, all those properties brought on the need for third-party management within Marriott.
And I also think, and you can tell me if I'm wrong, but I felt as if a lot of these management companies started to be created as folks started aging out of traditional hotel jobs. They started to get a little older. They either wanted a new personal challenge or their salaries were a little too expensive and they got let go by the mothership company, and then they decided to start management companies.
Yeah, I think, there's lots of reasons for the emergence of management companies. I think hotel investments became an industry in itself.
Right, and much more sophisticated.
Much more sophisticated. But as an owner, understanding some key aspects of a management contract are important, right?
So what are those aspects of a management contract? Because when I'm sitting here uneducated about the nuances of all of these things, all I really know is that typically they get paid a fee and maybe a percentage of the profits. That keeps the skin in the game.
Correct. So, there's lots of nuances to discuss and things to negotiate in a contract, but we're gonna focus on some of the top bigger issues.
Yes.
The first thing that you discuss is the term.
Right.
How long is a contract? Is the contract 10 years, 5 years, 20 years? Most brands are going to, if you're doing a brand managed, because remember the brand is tied to it, they're going to want a very long agreement.
Like 20 years.
20 is usually the average, 25. And then they're going to have renewal periods. And they could have maybe 5 years, 3 10 years. caution to ownership is you need to make sure that that's a mutual. Typically, the brands will try to push in it's at their discretion only.
Right.
But you want to make sure that you can have the ability to not renew if you want as an owner.
Right. Shocking. So the person that you're entering into business to is looking for terms that are more favorable to them. Sounds like every other business.
Exactly. So you need to kind of meet in the middle. So term is an issue.
But term is also important, I think, when it comes to getting financing, because the bank wants to know you're going to have the security of a particular flag for X amount of years.
Correct. And then on the franchise side, it's like 14, 15 years or so as well. You're absolutely right. For securing financing, it's important. Wow, you do know a little bit, don't you?
I think I know more than I expected, but don't worry, my lack of knowledge will rear its ugly head any minute now. I'm sure. Gary.
Excellent. I'm glad to hear that, because it'll make the show a little bit more entertaining. Because this topic can be dry. And then when you talk about the fees, so there is two components of fees. There's what we call a base fee, as well as an incentive fee. And the base fee is typically a percentage of revenue, and then the incentive fee works off of some percentage share in profit. And there's different ways on the incentive fee that can be calculated. One, we could say we receive 10 or 20% of every dollar over budgeted GOP, budgeted profit. But another way to look at it is to look at what the ownership's investing in the hotel, and they're expecting some type of preferred return. So, for example, if they were to invest $1 million in a hotel and want an 8% preferred return on that, expect an 8% return on that money, that would be $800,000 a year. So therefore, you could set the preferred return to be $800,000 a year, and then the management company would receive 10 or 20% of every dollar over that number.
Okay. So to try to understand it, there's like a threshold that has to be achieved, and then the incentives kick in after. Sounds to me very similar to the way like a general manager's contract might be structured, where all of a sudden you get bigger bonuses after you have enough revenue for a property.
Absolutely. And aligning the interests of the ownership and management, the incentive fee allows that to happen, right? Because we're both concerned about making profit and maximizing profit, because it lines up both our pockets, we're in alignment. So what we try to do when we negotiate management agreements is negotiate less of a fixed base fee, because that's fixed, it's percentage of revenue. Ranges between 2 and 4% typically. So we'll try to get it closer down to that 2% margin, and then negotiate a larger incentive fee so we're more aligned with ownership and management.
So how does that work, though, negotiating? Because they want less, you want more. Right?
Yeah.
So
I'm not going to give you all the tricks.
Well, I guess that's why they got to hire you, Gary, right?
But basically, to put it very simply, is you identify all your asks. Some asks might be more important than others.
Right. All right. So typical negotiating.
Negotiating.
Okay. What else do we need to know?
The other thing that's really important to the contract, and probably one of the most important, is having a performance clause. So allowing ownership to terminate the contract based on performance.
Right. So if you wind up hiring a management company that's not living up to the standard just set in the agreement, you're not stuck with them forever.
Correct. And a lot of times, at least the off-the-shelf language that comes on the performance clause is almost impossible to ever terminate. And the reason being is most of them have a two-prong test. The first prong being making some attainment of financial performance, whether that's the preferred return or that's the budgeted GOP. There's some threshold for profit, right? Then the other side of it is so that's the profit hurdle. Then the second part of the prong of the test is usually a RevPAR performance. So if the hotel is performing a RevPAR index of some percentage, so for example, let's say it's 100%.
Right.
You're running at 100% of the market. They'll sit there and say if you fall below that 100%, you could be terminated. But if you maintain 100%, you can't be terminated. And the reason for that is to protect the brand and the management company. Think about it. If we have a black swan event, or another 9/11, or a meltdown of the banking system and so forth that causes the economy to drop, if just because the hotel's not making its budget or its preferred return to owner, should the owner have the right to terminate if the hotel is performing the best it can in the marketplace.
So what that does is that tethers it to everybody else within the market. So if there is some sort of unexpected but highly negatively impactful event, the entire market drops 20%, then all of a sudden they're still getting that 100% of what they could possibly get and achieving their goals for the circumstances that they're in.
Correct. So in theory, that's how it works.
Right.
However, the typical ask of most management companies is their ask is 85% of budgeted GOP. So if I fall below 85% of what I told you I was going to do,
right?
Okay, that's the first test prong. And then the second one would be 85% of my RevPAR index. Okay, we'll talk about that in a second.
Okay.
Then they basically say, then you have to fail both of those tests for 2 years consecutively. You do both those tests for 2 years consecutively, you can terminate us.
Wow. Okay, that makes a lot of sense. I think I've taken a lot around here, a lot from you. Number one, love the word prong. There's something really good about that word. But I like what you're saying. So there are protections for both the ownership group and the management company.
Hi, this is Gary Isenberg with LWHA Hospitality Advisors, president of their asset management division, where we bridge the gap between hotel ownership and management. View us at our website at www.lwhospitalityadvisors.com. You can always email me at gary.isenberg@lwhadvisors.com. Feel free to call me as well at 212-300-6684, extension 108. Look forward to speaking to you or receiving your emails.
You invest so much time and effort as a management company, you do need to have some sort of protections, even if it doesn't go well for just 1 year.
Correct. And I think from an ownership perspective is what you really want to see is you want to see that on the RevPAR index, that you're as close, that threshold is as close as possible to what the anticipated performance of the hotel is. If you're expecting your hotel to perform 100% of your fair share in RevPAR, you'd want that threshold to be maybe 95% of the market.
Right. So that gives you a little bit of
So they have a little bit of room to drop, but not a lot. If you're operating at 105%, you're not going to agree to an 85% RevPAR. Right. That seems silly, right? To allow them 20% drop.
Yeah, because then they could get
that's
lazy.
Poor performance. Well, that's poor performance. You're not keeping up with why the RevPAR index is there. Is to protect management not from poor performance, but from continuing to perform well in a bad market.
So what are the differences then when you're talking about a brand new build hotel, which needs a ramp up time, or an existing hotel, or one that already exists but is getting a new flag?
Good question. So that's a great question. So typically on performance clauses, it only starts after a certain period of time. So in a new build construction, it would say after year 3 or 3 and beyond is when the performance hurdle starts, initiates. So in other words, if it starts in year 3, then the test years would be year 3 and year 4. If it started in year 4, the test years would be 4 and 5. What we typically try to negotiate is again, like I said on RevPAR, bring it as close as possible to what you're performing. On the GOP threshold, we typically want to tie that to a preferred return. And the reason for that is if you tie it just to budget, there's reasons why budgets may change. I want to know, am I making the money that I anticipated? When you gave me a performer when I first signed up with the brand, you said we're going to do X. Let's make sure we're continuing on that threshold.
So would year 4 or 5 change? Because the differences between year and 4 or 5, you may have to be paying higher salaries. You may be changing the rate that you're charging. All of those kinds of factors start to come into play, perhaps?
Well, yes, but again, you want to make sure that. Correct, I agree with that. But that's the entire ramp up of really the sales side of it more than the expenses. Your expenses kind of start from day one, but it's really making sure that you get ramped up to your expectation of revenue.
Yeah, it's funny. You were just a guest on Checking In with Anthony and
Glenn.
Correct. That's another show that I happen to do, and you and Anthony Melchiori, who's the former host of Hotel Impossible on the Travel Channel, were saying that it's a revenue-driven business as opposed to an expense-driven business. Sounds to me like that informs how management contracts are negotiated too.
Correct, and they're definitely focused on driving the top line and balance with profit. But I think the things to keep in mind on the performance hurdles is, again, you want to make sure you're measuring the right things. The other thing is the 2-year double prong test for 2 years. You like the double prong? I threw that in there just for you, Glenn.
I do appreciate that, but I'm feeling like maybe that's a little dirty.
So the double prong test for 2 years concerns us because it makes it very difficult to truly terminate for poor performance with having to do 2 years consecutively. So what we try to do is try to negotiate as much as possible, some flexibility there. Maybe it's the 2-year test on the second. It's the first year is both you have to fail, and the second year maybe you fail one, or so forth and so on. But again, it's a discussion and negotiation of where you get, and everything works in the entirety. So if you're asking for key money, the brand may look at the performance hurdle differently than if you're not looking for key money, and so forth and so on.
Since we're really trying to educate people, maybe share what key money is specifically.
Great question. I thought I was asking the question. So what is key money, Glenn?
Oh, yeah, you were supposed to ask those questions. But then you accused me of knowing too much, and I start to get shy. I believe key money is a amount of cash a flag will provide to you for signing a deal with them that has specific parameters in it. Perhaps it's a new and emerging brand, and they want to be in a particular location. So that we'll say, if you build this hotel, we will give you X amount of dollars per room to do it.
Absolutely correct. Whew. And what's interesting about it, Glenn, though, it's a loan.
Yes.
They're actually loaning you the money.
That I didn't know. I thought it was just free money.
Well, it is and it isn't. So basically, it's a loan that amortizes. The principal of the loan amortizes every year for the length of the contract. So if you're in a 20-year management agreement and they give you $1 million, $200,000 a year of that principal will amortize each year. So if you terminate the contract in year 5, you still owe them $500,000. That's how it works.
That's a problem. But what it does is it enables the owner, operator, or developer to get in there in a way that they might not have been able to afford before.
Yes. It really all depends on what you need for your cap stack to invest in the hotel. Typically, what we find is that key money is expensive money, even though you're not paying interest on it, you're not having to pay it back. But the reason why it's expensive is you give up other things in the contract and other fees and so forth, or deductions and fees, in order to get that.
Right.
And we find it's more valuable, for example, to negotiate a better base management fee so that your expenses in the P&L going forward are lower, so you have higher NOIs throughout the entire hold period.
Right.
So therefore, you actually increase the value of the property when you go to sell it, versus this key money that when you go to sell it in 5 years, you're going to give money back. So you really have to look at the value of that money and analyze it, which way is better to go.
And when you say cap stack, you're not referring to a new meal at Denny's. You're referring to all the different components that you put in, where all the different financial, either money you're bringing to the table, what a bank is bringing to the table, mezzanine loans, all of those things to create the ability to build your property.
Correct. It's kind of like if you look at, a jar and put rocks in, right? And sand and so on, and all the different levels. That's the cap stack, meaning, the largest piece is going to be a debt piece probably.
Right.
Then there's equity and so forth. And there might be some mezzanine debt in there and different levels of debt and equity.
Excellent. Well, I feel like I know everything about management contracts now, but I feel like maybe there's a lot more that I don't really know. I'm getting a little too confident here, Gary.
Yeah, there's lots of information. There's lots of things that need to be negotiated. But I think we've covered the bigger issues, the bigger buckets, so to speak, for ownership. Obviously, one last thing I'd like to comment on is also an area of protection, also known as AOP.
Okay.
And what's important about that? Now that also plays into the franchise area.
I know. I got stuff to say on this.
And and depending on where your hotel is, you may have a very large area of protection or a very small area of protection. If you look in Manhattan, for example, Glenn,
right,
there's a Hampton Inn, I think, on almost every block in Midtown.
Yes, right next to the Starbucks, which is on every single corner. But to be fair, there's so many people per block in New York City compared to so many people per block in whatever town, in, like, say, Des Moines, Iowa, for example. So the area of protections would be different sizes.
Correct. And in New York, for example, in the city with those Hampton Inns, literally those area protections are blocks.
That's insane.
Isn't that insane?
So they wouldn't open a Hampton Inn right next door to the Hampton Inn.
But maybe a half a block away. Very interesting. And it's funny, Glenn, the last company I was with before joining LW Hospitality Advisors, I built the first Hampton Inn in New York City.
Was that the one that was on 8th Avenue off Times Square? Because that was a conversion.
So let me clarify. I built the first hotel that entered New York City limits.
Okay.
Of Hampton Inn. And that happens to be the Hampton Inn at JFK Airport.
I was going to say, it's got to be my airport. Sorry. I'm like every other New Yorker. We just think that New York means Manhattan.
Correct.
And, other boroughs you have to say specifically.
So it was a little bit of a trick question there.
Yeah, like I didn't live in New York. I lived in Brooklyn for 20 years.
Right. and also, when you're a New Yorker, upstate is everything north of the Bronx.
That's right. Good. I like that you're sharing geography lessons for how us New Yorkers feel it. Yeah, it's funny. I was in upstate New York recently. Going to the Turning Stone Casino Resort in the middle of New York, and I don't even consider it New York. It's like a completely different universe
country.
Because it was above the Bronx.
Right.
Sometimes Westchester fits in New York, depending on the conversation.
It has of late in the last 10 years, maybe. But when I grew up, it did not. Anyway.
All right. So back to the area of protection portion of it. You are protected, but you're only protected for your specific brand.
Yes.
Right? Because I think that opens up an interesting conversation, because we're seeing brands open other brands that are extremely close in expected revenue.
How true you are.
I didn't want to say that. Right. But yeah.
All I did was agree with you.
That's absolutely right. That's all that happened here. Completely agreeing. So then all of a sudden that changes all the rules of engagement.
Correct. And yeah, that's a concern for building hotels and developing hotels is, will the brand create another brand and put it right next door to you? The reality, though, is keep in mind, one of the things that happens if a brand is developing another brand of your brand or a different brand,
right?
You have the right, typically under your franchise agreement, to do an impact study. And one of the things impact studies look at is what is the incremental impact of the branding, because if this market supports it, a hotel's going there anyway. If you're an IHG branded hotel, maybe you can keep them from putting an Avid or a Holiday Inn Express next to you, but you can't stop a Hampton from going in,
right, or
a Fairfield from going in, and so forth. So the idea is a hotel's going there anyway. So how much business are you really going to lose because of being associated with the same brand you are? So it becomes a lot less impactful when you slice and dice and look at it that way.
And it's interesting. And compared to 20 years ago, I think that the economics of the business has changed and the sophistication has risen so much. And I see it with a certain brand that may or may not have been mentioned recently, that a lot of folks are developing that brand across the street, or et cetera, from the one that they already have, more so they have the opportunity to profit off of it instead of giving it to somebody else.
Correct. But again, if the market supports having a hotel, it supports having a hotel.
Right.
So whether it's affiliated with the family of brands or not, the hotel's still coming, right?
Right.
Anyway, but going back to the area of protection, the other thing to keep in mind on area of protection is of late, within the last 10 years or so, the brands are burning it off. Mm-hmm. Meaning that they only allow the area of protection for some period of time. So maybe it's 5 years, maybe it's 10 years. It's allowed you to get through the ramp up and get stabilized. What we've been successful in doing is extending that area of protection. So one, getting a larger area of protection for maybe the first 5 years, and then having a smaller area of protection for the second 5 or 10 years.
That was going to be my next question. I think that's great because it protects you and then gives the franchise company an opportunity to make another deal as well.
Correct. And at least still gives you protection. So instead of being, having 2 blocks, you might only have a half a block.
Right. Excellent. Well, I look forward to the first ever Hampton Inn built within Hampton Inn.
And that's coming.
I know. I wouldn't be surprised. Anything else that we need to consider in this, Gary?
I think we covered a lot today, and I think it was great meeting and talking with you again, as always. And I look forward to our next show. Yeah,
I do too. I look forward to it too. This has been absolutely great. Gary, if people want to find you, how can they do that?
They can find me via email at gary.isenberg, ISENBERG, at LWHospitalityAdvisors.com.
Great. And be sure to subscribe to this show. And it's easy enough. It's already going out through the No Vacancy with Glenn Haussman feed. So just subscribe to the No Vacancy podcast wherever you like to get your shows. iTunes, Google Play, Stitcher, wherever it might be. That's where we are. Just click that subscribe button or subscribe to our weekly newsletter. Text the word hotel to 66866. That's the word hotel to 66866, and you'll get notification of every single new Business of Hotel podcast that's released. Gary, you have a newsletter or anything like that people can sign up for?
I do. Send me an email and we'll get you on the list.
All right, excellent. I love it. I want to thank you all for listening, and we'll be back next time with the Business of Hotels podcast.
Great. Thanks, guys.